Hi, welcome back. Every 2 decades or so, the US establishment wakes up to a truth that we've all known, which is that the US tax code as it exists today is an abomination. It's an abomination because it encourages perverse behavior on the part of US companies. So, whenever a new tax reform package is presented, the people presenting it always argue that the objective is always the same. It's to make the code simpler and fairer. I might be cynical on this one, but at the end of the process, the actual results are the exact opposite. Every tax reform package seems to make the tax code more complex rather than simpler and less fair rather than more fair. But perhaps, this time is different. So what I'd like to do is put the tax proposals that have just come out from, and they're not going to be law. So in a sense, we might be jumping way ahead of ourselves. There might even be no tax reform. But to the extent that a proposal is out there, I'd like to put it under the microscope to see what effect it will have on both corporate behavior and value. Now let's start with the value focus. To understand how taxes affect value, let's go back to basics. There are 3 big drivers of value. The first, of course, is the cash flows you get from your existing investments. Those cash flows are cash flows left over after reinvestment, and to get to them, you start with after-tax operating income. So taxes already enter the picture, and you subtract from it net capex, difference between capital expenditures and depreciation, and change in working capital. That's a reinvestment you're putting in to keep the company going. So that's the first big driver, is cash flows. The second is the value of growth, not growth per se, because growth has both pluses and minuses. Growth, of course, the good side is it makes your earnings go up. The bad side is you got to reinvest to create the growth. The value of growth is a function of 2 variables. One is how much you reinvest, captured with the reinvestment rate, the percentage of your after-tax operating income you put back into the business, and how well you reinvest. And that's captured by an excess return. What's an excess return? It's what you make over and above your cost of capital. Put simply, growth has no value if you just generate your cost of capital in your new investment. So for growth to create value, you have to earn excess returns, a return on capital that exceeds your cost of capital. So you got cash flows, you got the value of growth, and of course you got to adjust for risk. And in a discounted cash flow valuation or intrinsic valuation, that risk is captured in a discount rate. The discount rate is usually a cost of capital. It's a weighted average of your cost of equity and your after-tax cost of debt. Already you can see taxes enter both into your cash flows, perhaps into your growth rate, and even into your risk. So that's what I want to start with, is how do tax rates affect value? So let's start with the effect on cash flows and growth rates. There are 4 components to the tax code that drive cash flows and growth rates, and here are the 4 components. The first is the statutory tax rate on U.S. income. So basically what the code says, U.S. income made domestically by a U.S. company is going to be taxed at. The second is, how does the tax code treat foreign income? The third is, to the extent that the tax code includes tax credits and deductions, it can affect what you pay in taxes. And finally, the rules on what you can expense and what you can capitalize can have an effect on your cash flows. Let's see how. Those provisions of the tax code affect corporate behavior. Corporate behavior in what dimensions? They affect how much is paid in taxes. The tax code will determine the end game, how much companies pay in taxes as a percentage of their income. It will also affect how they deal with foreign income. The way foreign income gets taxed is not only going to affect how much companies report as U.S. and foreign income. Because let's face it, companies do have discretion in how they move their income along. But what they do with foreign income, whether they bring it back to the U.S. and reinvest, whether they leave it in a foreign territory, that's affected by foreign income taxation. And finally, how much, where, and how companies invest is affected by both tax rates and the treatment of expensing and capitalizing. So the tax code clearly affects corporate behavior, and you can observe the effects of that behavior in the numbers. In what sense? Remember that cash flows are after-tax cash flows. So basically you start with after-tax operating income. What companies pay as an effective tax rate, an average tax rate across all their income, is affected. And this is stating the obvious by the tax code. It is going to also affect how much companies reinvest. That capital expenditure number will be affected by the tax code. So the end result is tax codes can affect after-tax cash flows. By affecting the after-tax earnings, tax codes also affect the return on capital you make on investments. You're saying, so what? Remember, the value of growth is a function of your excess returns. By altering your return on capital, the tax code can make not just good investments, better investments, but broaden the excess return and affect how much companies reinvest and the value of that growth. So the tax code clearly affects cash flows and it clearly affects the value of growth. Well, really, let's look at the discount rate. How does the tax code affect the discount rate? The most direct effect of the tax code on the discount rate is in the tax tilt that it has towards debt as opposed to equity. How are interest payments treated as opposed to cash flows to equity? If interest expenses are tax deductible, you are creating a tilt in the tax code, and the way it's going to show up is through an after-tax cost of debt and also in how much companies borrow as opposed to using equity. So the tax code affects both the after-tax cost of debt and the proportion of capital that comes from debt, and through that it affects the cost of capital. There's also a more subtle effect of the tax code, and this is at the investor level. The way investors get taxed on dividends and capital gains can affect the equity risk premiums you see. And those equity risk premiums you can think of as the price of taking equity risk, and through that they affect the cost of equity. The way investors get taxed on interest income that they get on bonds that they hold can affect default spreads, and through that the cost of debt. So the tax code, in addition to affecting cash flows and growth rates, can also affect the cost of capital you see for the company directly through how interest payments are made tax deductible, and indirectly through the treatment of investor income or from dividends, capital gains, and interest income. So the tax code clearly can affect value. So let's take a look at the existing tax code and let's see how it plays out in the actual numbers you see for US companies. Here's what the tax code looks like. Right now, the federal marginal tax rate on corporations is 35%. You're saying, but they don't pay that. Hold back on that. The marginal tax rate for US companies is 35% for US income. For foreign income, the US adopts what's called a global tax model, which is it wants to tax foreign income at the US tax rate. What does that mean? If you're a US company, you're a US multinational, let's say you make income in Hong Kong, and let's say that the corporate tax rate in Hong Kong is 15%. So when you make income in Hong Kong, you're going to be taxed 15% by the Hong Kong tax guide. The US tax authorities now want you to pay the extra tax. So if the US tax rate is 35%, they want you to pay the extra 20% on that income. That's why it's a global tax model. But that income doesn't get taxed, the way the tax code is written right now, until it is brought back to the US. Talk about perverse tax codes. As a consequence of that provision, here's what multinationals do. When they earn income outside the US, knowing that they're going to have to pay the extra tax when that income comes back to the US, they leave that money outside the US. This creates what's called the phenomenon that you've heard of that's called trapped cash. What's trapped cash? It is money that's held in foreign locales. It's trapped because that money cannot be used for any U.S. purpose. It cannot be invested in the U.S. It cannot be used to pay dividends. It cannot be used for buybacks. You know what it can be used for? It can be invested outside the U.S. Talk about perverse consequences. It also induces companies to try to move more of their income outside the U.S. The divergence between the U.S. tax rate of 35% and the rest of the world has much lower corporate tax rates means that you have a lot of tax game playing. Transfer pricing, U.S. companies trying to move their income overseas and then leave that money trapped as trapped cash. Finally, if you look at how this all plays out in reinvestment, U.S. companies collectively reinvest about 5.26% of their revenues in net capex. You're saying, is that high? Is that low? Well, for the moment, just hold on to that number, because one of the questions that might be worth asking is if this Tax Reform Act works in its objective of trying to get U.S. companies to invest more, will that number increase? So here's what you see. You observe a 35% tax rate, but what U.S. companies effectively pay is much lower. It's about 26%. Why is it lower? Because they leave foreign income outside the U.S., and that foreign income left outside the U.S. has created a trapped cash balance of about $2.5 trillion or more. It also shows up in the operating numbers. The average after-tax operating margin for U.S. companies reflects the effective tax rate that they pay. It's about 9.3%. And the total reinvestment that U.S. companies made in 2016 with the old tax code, they reinvested about 70% of their after-tax operating income back. And when you look at the return on capital and cost of capital, again a consequence of the tax code, right now U.S. companies are generating about 0.9% more than their cost of capital. That's not bad, but it's not great. So when you look at the current tax code, it does create some perverse behavior in terms of where companies invest and how much they've left as cash outside the US. It has consequences for after-tax margins, reinvestment, and return on capital. It also has consequences for the way US companies fund their operations. The US tax code right now encourages debt by giving debt a significant tax benefit. Interest expense are tax deductible, and here's where the other perverse consequence of the code comes in. Remember, we saw that US companies pay about 26% of their income as taxes because they hold back foreign income, or paying the extra taxes on foreign income. When they borrow money, though, U.S. companies are going to borrow money in the U.S. Why? Because that's where they get the biggest tax benefit. In fact, at the margin, U.S. companies are going to find a way to get the maximum tax benefit that they can. And in the U.S., if you take the federal tax rate of 35%, add state and local taxes, that marginal tax rate on debt is close to 40%, which means if you pay a 4% cost of debt, after taxes, that's going to be 2.4%. In fact, collectively, U.S. companies had a pre-tax cost of debt of 3.67%. But if you allow for the full tax benefit at the marginal tax rate, they're effectively borrowing money at 2.22%. Their cost of equity is much higher, 8.59%. And because the after-tax cost of debt is so much lower than the cost of equity, not surprisingly, the U.S. companies use a substantial amount of debt. Their debt is about 26% of capital. Equity is the remaining 74%. Now, if you look at how investors get taxed on dividends and capital gains right now, they get taxed at the highest marginal tax rate on those dividends and capital gains is 23.8%. It's 20% plus the healthcare tax of 3.8%, 23.8%. Interest income, though, gets taxed as ordinary income, and right now ordinary income can be taxed at rates as high as 39.6%. Now, those play out as equity risk premiums and default spreads. And at the start of 2017, the equity risk premium in the U.S. was 5.69%, and the bond default spread for a BAA rated bond was 2.45%. So, in a long-winded way, what I'm trying to say is the existing tax code plays out in how much companies borrow, what rate they borrow at, the after-tax cost and overall cost of capital. So now let's look at what the proposed changes to the tax code are in this tax reform. Again, I'm not suggesting that all these changes will happen. In fact, none of them might happen. But let's take a look at the proposed changes. The first is, and this is perhaps one of the bigger changes, is the tax rate on U.S. income, at least based on the proposed reform, is going to drop from 35 to 20%. Second, and this is almost as big, in my view, it's an even bigger change, the U.S. will shift to a territorial tax model. What does that mean? If you're a multinational and you earn income outside the U.S., you will have to pay foreign taxes at the foreign tax rate, but the U.S. will not charge you that extra tax rate of the differential tax rate between the foreign income tax rate and the U.S. tax rate. That brings the U.S. in line with much of the rest of the world, because much of the rest of the world is shifted to a territorial tax model. Now, remember the $2.5 trillion in trapped cash. That's not going to go away with this change. So, at least based on the reform, there is talk of a one-time tax that will be imposed on the trapped cash. The numbers are range from 5 to 10%, an extra tax rate, and once that tax rate is paid, the trapped cash will be untrapped. What does that mean? Companies can do whatever they want with the cash. They can pay dividends, buy back stock, take new investments. So that's the tax change on foreign income. There is also a proposed change on capital expenditures. Rather than amortize and depreciate these expenses, as U.S. companies have historically been required to do, for a 5-year period, there's talk of allowing companies to expense capital expenditures. What does that mean? You can take an upfront tax benefit instead of spreading it out over time. And this is going to be particularly helpful to companies which invest in physical assets. Because right now, if you're a company which invests in intangible assets through R&D, you already get this benefit. So in a sense, it brings the non-technology sector in line with the technology sector. And finally, while there was talk earlier on of limiting and perhaps even eliminating the interest tax deduction, that talk seems to have dissipated. There is talk of restrictions on interest tax deductions, but the restrictions are more like limits, and it's only for certain types of corporations. So it's C corporations. So it's really not a substantial change in the way interest expense will be treated. But remember, you now will get only a 20% tax benefit from interest because the tax rate will come down. Let's see what the effects of these changes will be on both cash flows and growth, and then on discount rates. So let's start with how the tax rate is going to play out. Lowering the tax rate from 35 to 20% is going to lead to a lower effective tax rate. We kind of know that. We know that, but how much lower will depend, right? It'll depend because right now, remember, U.S. companies are not paying a 35% tax rate. They're paying only 26%. So there'll be a lower effective tax rate, which will lead to higher after-tax cash flows and higher after-tax earnings and returns on capital. The firms that will benefit the most from this change are firms that pay very high effective tax rates. So if right now you're paying a 14, 15, 16% effective tax rate, you're not going to see a big benefit from this change. But if you're paying a 31, 32, 35% effective tax rate, you should expect to see a much bigger benefit. The lower tax rate, though, will also affect your cost of capital. And in a perverse way, it'll push up your cost of capital. Why? Remember that after-tax cost of debt that was based on a 40% tax rate? That after-tax cost of debt is now going to get higher because your tax benefit will be lower. And companies may even choose to borrow less. So there will probably be an increase in the cost of capital. And already you can see that the consequences of a lower tax rate on the value of growth are going to be unpredictable. Unpredictable, why? Because both the return on capital and the cost of capital are going up. Which goes up more will determine whether the value of growth will increase or decrease. For companies that have high effective tax rates right now, and have very little debt, the benefit is going to be mostly positive. For companies which have very high debt ratios and pay low effective tax rates, you could very well see lower excess returns after this change. And that could, in fact, lower the value of growth. The change in the tax laws on foreign income are going to lower effective tax rates, especially for companies that derive a lot of their income from outside the U.S. It's going to have an effect on the cost of capital, but by perhaps inducing some of these companies to borrow outside the U.S. Perhaps you might borrow money in a country with a marginal tax rate of 25%, higher than the U.S. You might see a shifting of debt to other locales. And there is going to be that one-time release of trapped cash that these companies can use to perhaps reinvest more. But that's going to be true only if they're earning returns on capital significantly higher than the cost of capital. So the tax changes in foreign income are going to be primarily felt by multinationals, companies that derive most of their income or derive some or a big portion of their income from outside the U.S. The expensing of capital expenditures will have a consequence, but the consequence will be greatest for companies that have a lot of physical assets, that invest in a lot of physical assets. So if you're a company that makes a lot of investments in infrastructure and plant and equipment, you will get that benefit for 5 years of being able to expense these items rather than spread them out over time. The cost of capital shouldn't be affected by this, but it could increase the value of growth at companies with a lot of physical and fixed assets, and which are making a lot of new investments in these assets. The interest tax deduction limits should not affect your after-tax cash flows, but they could increase your cost of capital if you're one of those few companies that's actually going to be hit by one of these limits. So if I restrict you from deducting interest expenses, it pushes up your cost of debt and your cost of capital. And it'll decrease the value of growth at companies which violate those limits that have been put on interest tax deductions. So already you can see it's a mixed bag, right? The lowering of the tax rate will increase after-tax earnings and perhaps cash flows, but it will also raise your cost of capital. The net effect is what's going to drive whether you benefit or not. So if you ask me to determine who the winners from this new tax code will be, here are the characteristics I look for. I'd look for companies that pay high effective tax rates. If you're paying a high effective tax rate, either because you make most of their income in the U.S. or because you repatriate your foreign income to the U.S., you're going to see a lower effective tax rate after the tax code. So you're going to benefit. You have less debt, you're going to benefit because you weren't affected by the fact that debt is now less attractive from a tax perspective. If you earn healthy returns on capital, that helps you because that's going to create more value from growth because you can now augment that return. And finally, this is going to be more helpful for companies with physical assets and intangible assets, non-technology companies, because in a sense, I'm allowing you to do to your capital expenditures what technology companies do with R&D, get an immediate tax deduction. So the companies that are going to win from this tax reform are going to be companies with high effective tax rates, very little debt, high returns on capital, with a lot of physical assets. Who are the losers going to be? The biggest losers will be companies that have very low effective tax rates right now and have a lot of debt in their capital structure. Why? Because they're not going to benefit from the lower tax rate. They're already paying very little in taxes. And the fact that debt is now less, has a higher cost will affect the cost of capital. So these are the companies that will be hurt the most by so you could actually end up with these companies being worth less after the tax reform than before the tax reform. Some of these companies may be helped out by the fact that they have trapped cash that's going to be untrapped, but that's a one-time deal. And if their projects are not that good, most of that cash is going to go back to stockholders in the form of dividends and buybacks. So overall, if you ask me to assess this tax reform, I see both good news and bad news. The good news in these proposals is there's now this is a more realistic tax code when it comes to foreign income. For about 3 decades now, the U.S. has deluded itself into believing that if it just forced U.S. companies to return their income to the U.S., they would just bring the income back and pay the higher tax rate. The way I see it is you really no longer have U.S. companies. You have multinationals that through the accident of history happen to be U.S. based. You got to accept the fact that you can't force companies to bring income back to the U.S. If you tried, you're going to force them out of the U.S. It's much more realistic to adopt a territorial tax system as the new package is adopting and release that trapped cash. It's not healthy for companies to be sitting on $100 billion, $150 billion, or in the case of Apple, $250 billion in trapped cash. So I think that the way the new tax code deals with foreign income is much healthier. I also like the fact that the tilt towards debt is reduced by reducing the tax rate and perhaps putting limits on interest tax reduction. The reason I think that's good is I think there's too much attention paid to the liability side of the balance sheet at U.S. companies. There's too much value that companies think they can create by changing their debt ratios, and that's because of the way the tax code is written. I'd much rather see that tax benefit reduced and companies focus on improving operations. So that's the good news. What's the bad news? The first part of the bad news is that while I understand the motives for what the reform is doing in terms of allowing capital expenditures to be expensed right away, and the motives I think it's and also if you think about some of the other provisions they're bringing in, I think the problem is I think it's going to create, if there's a gap already between tax books and reporting books, it's going to make that gap a much wider one. And here's why. If you expense capital expenditures, it's good for you in terms of saving in taxes immediately. It's good for your cash flows, but it's bad for your earnings. And we know how companies feel about earnings, right? So here's what's going to happen. In the reporting books, companies are going to stick with the old system. They're going to treat capital expenditures as capital expenditures, but they're going to show the low tax rate that they have because in the tax books, they're going to expense the capital expenditure. So you're going to end up with two very different sets of numbers in the two books. Perhaps we shouldn't allow companies to have two sets of books, but I think it's going to make valuation investing more difficult because what you see in the reporting books is going to be very different than what you see in the tax books. Here's the other piece of bad news. When you have different tax rates on different entities, you encourage all kinds of tax game playing. In fact, one of the original objectives of the 1986 tax reform package, I'm old enough to remember when that package was presented, is that tax reform package was directed at a very worthy objective. It wanted to bring the tax rate to 28% for all kinds of income. Dividends and capital gains, ordinary income, and basically they wanted to bring the tax rate to 28% for everybody. The reason is if you do that, then there's no incentive for an individual to become a partnership or a partnership to become a corporation or a corporation to become, because everything's going to get taxed at 28%. That objective very quickly got mangled as Congress started to play with the tax code. And this reform package is going to make tax differences bigger. Because here's what the tax rates are going to look like after this package goes into effect, if it does. First, investment income, this dividends and capital gains, will continue to get taxed at 23.8%. So nothing changes about the way they get taxed. Individual earned income right now gets taxed at 39.6%. And if this tax reform package goes through, the highest marginal tax rate is 35%. There's a mild drop in the tax rate from 39.6 to 35%. Pass-through income, so this is if you're a partnership and income passes through, is now the is going to get taxed at a 25% tax rate. So that's a big drop off, because right now it gets taxed as ordinary income in the hands of the partners. And finally, corporate income, the tax rate is going to go from 35 to 20%. You're saying, so what? For most of us, we have no choice about how we declare. So if you earn wage income, you have no choice. It is ordinary income. You have to pay the ordinary tax rate. But let's say you run a business. You have three ways you can actually structure your business. You can structure it as basically a sole proprietorship and pay the taxes on the income as ordinary income, in which case you're going to pay 35%. If you can structure your same business as a pass-through entity now, a partnership, that income is now going to get taxed at 25%. Already I am creating encouragement for you to find a way to convert your sole proprietorship into some kind of a pass-through entity. And if you can take your pass-through entity and make it into a corporation, the tax rate goes from 25 to 20%. Now I know the tax package also sees this coming, and it says, look, we're going to make sure that if you create a partnership, we're going to make you pay a salary and you have to pay the ordinary tax. That's not going to work. I mean, is the IRS going to decide what a right salary is for it? It is a recipe for tax tussles, tax planning. It'll make tax lawyers very happy, but the rest of us are going to pay a price. If I had my druthers, here's what I do. And of course, I'm not writing the tax reform. I'm not suggesting myself as a person to be involved in this process. Here's what I would do. I'd like to see the same tax rate on everybody. I'd much rather see a 25% tax rate on everybody. Corporations, pass-throughs, individuals. Go back to the 1986 theme, which is have the same tax rate. Of course, if you suggested this, people would say it's a giveaway for the rich, the tax. But you know what? The very rich are going to find a way to pay less in taxes, no matter how egalitarian you try to make the tax code. So I'd much rather see tax rates be the same and tax lawyers go out of the picture, but I'm not writing the tax code. So here's the end game. I hope there's tax reform, because I think the U.S. tax code is vastly in need of reform. There's some good news and bad news in this reform packet, and I hope that that at least some parts of it change, especially the way it treats foreign income and the way it treats debt. I do think that the divergence it creates in tax rates for different types of entities is not good news. I'd prefer to see more similar tax rates. But then again, I'm not writing the tax code, and I'm sure the divergence in tax rates will make tax lawyers happy, but the rest of us, as I said, will pay a price. Hopefully, we will see this process play out, and as we play out, and there are changes to the tax proposals, I will come back and revisit those proposals and see their effect on value. I'm not a tax expert, but remember, when it comes to tax policy, we're all biased. There are no objective views on tax policy. We all have strong priors about what we think comprises good tax code, and we will see the things we want to see. The reality is, we think that the tax code is unfair to us and unfair for. Basically, we believe that we're unfairly affected by the tax code and everybody else is paying less than their fair share. But the reality also is that writing a fair tax code is very difficult to do. Thank you very much for listening.